Question 1. An investment advisor registered at the state level is acting in a fiduciary capacity. This means the advisor must a. Prioritize the advisor's own interests above the client's interests in all investment recommendations. B. Exercise a high degree of care, honesty, and good faith in acting on behalf of the client. C. Guarantee investment returns to clients, regardless of market conditions. D. Provide investment advice only to accredited investors. Answer: B. Exercise a high degree of care, honesty, and good faith in acting on behalf of the client. An investment advisor's fiduciary duty is a core ethical and legal obligation requiring them to always put the client's interests first. This means acting with utmost care, honesty, and loyalty, avoiding conflicts of interest, and making suitable recommendations. For example, if an advisor receives a higher commission for selling one fund over another, but the lower commission fund is more appropriate for the client, the advisor must recommend the more suitable fund. Remember, a fiduciary is held to a higher standard of conduct than a typical salesperson. Question 2. Under the Uniform Securities Act, which of the following would generally be excluded from the definition of an investment advisor? A. A person who advises clients on the purchase of individual stocks and charges a fee based on assets under management. B. A person who publishes a general market newsletter that does not provide specific investment advice tailored to individual needs. C. A person who advises institutional clients on portfolio strategy for a fee. D. A person who manages discretionary accounts for high net worth individuals. Answer: B. A person who publishes a general market newsletter that does not provide specific investment advice tailored to individual needs. The Uniform Securities Act defines an investment advisor, IA, as someone who provides advice on securities for compensation as part of a regular business, but it includes specific exclusions. Publishers of general circulation financial publications that do not offer personalized investment advice are typically excluded because their advice is not tailored to specific individuals. This exemption ensures that broad market commentary, like a subscription newsletter offering general trends, does not require IA registration, whereas personalized financial planning for a fee would. Think of it this way: if the advice is generic and not tailored to a client's specific situation, it's often not considered investment advice for registration purposes. Question 3. An investor purchases a zero-coupon bond. Which of the following statements is true regarding its characteristics? A. It pays regular interest payments to the bondholder throughout its life. B. It is purchased at a discount and matures at its face value. C. Its price is highly sensitive to changes in interest rates due to its short duration. D. It can only be issued by municipal governments. Answer: B. It is purchased at a discount and matures at its face value. A zero-coupon bond does not pay periodic interest payments, or coupons, to the bondholder during its life. Instead, it is always issued at a discount from its face, par, value and matures at its full face value, with the investor's return coming from the accretion of the discount. For instance, an investor might buy a $1,000 par value zero-coupon bond for $800 and receive $1,000 at maturity, effectively earning interest through the price appreciation. Remember, since there are no intervening interest payments, zero-coupon bonds are typically more volatile than coupon bonds of similar maturities when interest rates change. Question 4. An investment advisor representative, IAR, reviews a client's portfolio and recommends selling several long-held, low-cost basis positions to purchase new, higher-cost basis positions that offer similar risk/return profiles, primarily to generate commissions. This practice is best described as A. Commingling, B. Churning, C. Selling away, D. Front-running. Answer: B. Churning. Churning is an unethical and illegal practice where an investment advisor or representative excessively trades in a client's account primarily to generate commissions or fees, rather than for the client's benefit. The key here is the excessive nature of the trades and the motive of generating compensation, even if the individual trade seems suitable in isolation. For example, repeatedly buying and selling similar mutual funds within a short period to rack up transaction charges would be considered churning. The focus is always on whether the activity serves the client's legitimate investment objectives or the advisor's financial gain. Question 5. Which of the following is most accurately described as a suitable recommendation for an elderly client on a fixed income who is primarily concerned with preservation of capital and consistent income? A. High-growth technology stocks. B. Speculative options contracts. C. Blue-chip corporate bonds with high credit ratings. D. Cryptocurrency investments. Answer: C. Blue-chip corporate bonds with high credit ratings. For a client on a fixed income who prioritizes capital preservation and consistent income, low-risk, income-generating investments are generally most suitable. Blue-chip corporate bonds with high credit ratings offer relatively stable interest payments and a lower risk of default compared to speculative investments. High-growth stocks, options, and cryptocurrencies are typically too volatile and carry too much risk for someone primarily focused on capital preservation and fixed income. Always align investment recommendations with the client's stated risk tolerance, time horizon, and financial objectives. Question 6. A registered investment advisor, RIA, must maintain a minimum net worth to operate. This requirement is typically established by A. The Financial Industry Regulatory Authority, FINRA. B. The Securities and Exchange Commission, SEC, for all RIAs. C. State Securities Administrators for state-registered investment advisors. D. The Public Company Accounting Oversight Board, PCAB. Answer: C. State Securities Administrators for state-registered investment advisors. State securities administrators are responsible for regulating investment advisors registered at the state level, including setting minimum net worth or bonding requirements to ensure financial solvency. The SEC primarily regulates larger investment advisors, those managing $110 million or more in assets, and does not typically impose minimum net worth requirements directly on them, instead focusing on disclosure. For example, a state might require an advisor with discretionary authority to maintain a minimum of $10,000 in net worth. This helps protect clients by ensuring the advisor has sufficient financial resources to operate responsibly. Question 7. An investor is considering a growth stock and wants to evaluate its potential future earnings. Which valuation method would be most appropriate for this analysis? A. Dividend discount model, DDM. B. Book value per share. C. Price to earnings, PE, ratio. D. Liquidation value. Answer: C. Price to earnings, PE, ratio. The price to earnings, PE, ratio is a fundamental valuation metric that compares a company's current share price to its per share earnings, often used to gauge how much investors are willing to pay for each dollar of earnings. It is particularly useful for growth stocks because it reflects market expectations for future earnings growth. For instance, a high P/E ratio suggests that investors anticipate significant future earnings growth. While other metrics are useful, the P/E ratio directly links current stock price to current or projected earnings, making it a key tool for growth stock analysis. Question 8. Under the Uniform Securities Act, which of the following is not considered a security? A. An investment contract. B. A fixed annuity contract. C. A variable annuity contract. D. A pre-organization certificate. Answer: B. A fixed annuity contract. Under the Uniform Securities Act, a security generally includes instruments where an investor expects profits primarily from the efforts of others, such as stocks, bonds, and investment contracts. While variable annuities are considered securities because their value fluctuates based on the performance of underlying investment accounts, fixed annuity contracts are typically not considered securities. This is because fixed annuities offer a guaranteed interest rate and pay a specified payout, meaning the investor does not bear investment risk and profit does not depend on the efforts of others. Keep in mind that a guaranteed return product, like a fixed annuity, usually falls outside the definition of a security. Question 9. An investment advisor has discretionary authority over a client's account. This means the advisor can a. Place trades in the account without first obtaining the client's specific approval for each trade. B. Make withdrawals from the client's account for personal use without prior notification. C. Change the account beneficiary without the client's consent. D. Borrow money from the client's account for firm expenses. Answer: A. Place trades in the account without first obtaining the client's specific approval for each trade. Discretionary authority grants an investment advisor the power to make investment decisions, such as which securities to buy or sell, or the amount of securities to trade, without obtaining the client's specific approval for each transaction. This authority must be granted in writing by the client. For example, if a client gives discretionary authority, the advisor can execute a trade to purchase 100 shares of XYZ stock without calling the client beforehand. It is crucial to remember that discretionary authority does not extend to taking money from the account, changing beneficiaries, or borrowing from the client. These actions require explicit client authorization. Question 10. A client wants to invest in a fund that holds a diversified portfolio of real estate, similar to investing directly in property but with greater liquidity. Which type of investment vehicle would be most suitable? A. A limited partnership. B. A real estate investment trust, REIT. C. A master limited partnership, MLP. D. A private equity fund. Answer: B. A real estate investment trust, REIT. A real estate investment trust, REIT, is a company that owns, operates, or finances income-producing real estate. REITs offer a way for individual investors to earn returns from large-scale real estate investments without having to buy, manage, or finance property themselves, and they are typically publicly traded, offering liquidity. For example, an investor can buy shares of a REIT that owns shopping malls or apartment complexes, receiving dividends generated from rent payments. This structure allows diversification into real estate while maintaining the ease of trading found in typical stock investments. Question 11. What is the primary difference between systematic risk and unsystematic risk? A. Systematic risk can be diversified away, while unsystematic risk cannot. B. Systematic risk affects specific companies or industries, while unsystematic risk affects the entire market. C. Systematic risk is inherent to the overall market and cannot be diversified away, while unsystematic risk is specific to a company or industry and can be diversified away. D. Systematic risk is always higher than unsystematic risk. Answer: C. Systematic risk is inherent to the overall market and cannot be diversified away, while unsystematic risk is specific to a company or industry and can be diversified away. Systematic risk, also known as market risk, is the risk inherent to the entire market or market segment, affecting all investments to some degree, and cannot be eliminated through diversification, example interest rate changes, recessions. Unsystematic risk, or specific risk, is unique to a specific company, industry, or asset class, example a company's labor strike, a product recall, and can be reduced through diversification by holding a variety of assets. For instance, a stock market downturn affects almost all stocks, systematic risk, while news about a single company's poor earnings primarily affects only that company's stock, unsystematic risk. Diversification is a powerful tool against unsystematic risk. Question 12. According to the Investment Advisors Act of 1940, which entity is generally required to register with the Securities and Exchange Commission, SEC? A. An investment advisor with less than $25 million in assets under management, AUM. B. An investment advisor whose sole clients are insurance companies. C. An investment advisor with $120 million in assets under management, AUM. D. An investment advisor that provides advice only on municipal securities. Answer: C. An investment advisor with $120 million in assets under management, AUM. The Investment Advisors Act of 1940 generally requires investment advisors with $110 million or more in assets under management, AUM, to register with the SEC, unless an exemption applies. Advisors with less than $100 million AUM typically register at the state level, while those between $100 million and $110 million have a choice. For example, an advisor managing $120 million for various retail clients would fall under SEC jurisdiction. The $110 million threshold is a key figure to remember for determining federal versus state registration. Question 13. When analyzing a company's financial statements, a significant increase in accounts receivable relative to sales might indicate: A. Efficient cash collection and strong sales growth. B. A decrease in sales and improved inventory management. C. Problems with collecting payments from customers or aggressive revenue recognition. D. A highly liquid financial position. Answer: C. Problems with collecting payments from customers or aggressive revenue recognition. An increase in accounts receivable, which represents money owed to the company by its customers for goods or services already delivered, that outpaces sales growth, can be a red flag. It might suggest that the company is struggling to collect payments from its customers, leading to potential cash flow problems, or that it is recognizing revenue prematurely. For instance, if sales are up 10% but accounts receivable are up 30%, it implies that a larger portion of sales are on credit and not being converted to cash quickly. This can impact a company's liquidity and overall financial health. Question 14. An investment advisor representative, IAR, is performing a suitability analysis for a client. Which of the following factors is least important for the IAR to consider? A. Client's risk tolerance. B. Client's investment objectives. C. Client's social security number. D. Client's time horizon. Answer: C. Client's social security number. While a client's social security number is essential for account opening, tax reporting, and identity verification, it is generally irrelevant to determining the suitability of an investment recommendation. Suitability analysis primarily focuses on factors like the client's investment objectives, example growth, income, capital preservation, risk tolerance, example conservative, aggressive, and time horizon, example short-term, long-term. For example, knowing a client wants long-term growth and is comfortable with moderate risk helps tailor investment strategies, but their SSN does not inform this decision. Always prioritize financial profile details when assessing suitability. Question 15. The Uniform Securities Act requires that every investment advisor keep records of its business. Which of the following is a key reason for this requirement? A. To allow investment advisors to easily track their personal expenditures. B. To facilitate audits by the administrator and ensure compliance with regulations. C. To provide a public directory of all client holdings. D. To enable unsolicited client requests for historical trading data. Answer: B. To facilitate audits by the administrator and ensure compliance with regulations. Record-keeping requirements for investment advisors are critical for regulatory oversight. These records allow state securities administrators, or the SEC for federal registrants, to conduct examinations and audits to ensure the advisor is complying with all applicable securities laws and ethical standards. For example, maintaining accurate client account statements, trade blotters, and client correspondence helps regulators verify that transactions were suitable and properly disclosed. Good record-keeping is not just a regulatory burden, it's a vital component of investor protection and transparency in the financial industry. Question 16. A client wants to ensure their investment portfolio provides a steady stream of income that keeps pace with inflation. Which investment strategy would be most appropriate? A. investing solely in high-growth, non-dividend paying stocks. B. Concentrating investments in long-term, fixed-rate bonds. C. Including inflation-protected securities, example TIPS, and certain real estate investments. D. Engaging in frequent speculative options trading. Answer: C. Including inflation-protected securities, example TIPS, and certain real estate investments. To combat inflation and maintain purchasing power, a strategy should include assets whose value or income stream is expected to rise with inflation. Inflation-protected securities, TIPS, are specifically designed to do this, as their principal value adjusts with changes in the Consumer Price Index, CPI. Certain real estate investments, due to their potential for rent increases and property value appreciation during inflationary periods, can also provide an inflation hedge. Focusing solely on fixed-rate bonds or non-dividend stocks would leave the portfolio vulnerable to the erosive effects of rising prices. Question 17. Which of the following statements about a Roth IRA is true? A. Contributions are tax-deductible in the year they are made. B. Qualified distributions in retirement are tax-free. C. Withdrawals in retirement are taxed as ordinary income. D. There are no income limitations for contributions. Answer: B. Qualified distributions in retirement are tax-free. A key feature of a Roth IRA is that contributions are made with after-tax dollars, meaning they are not tax-deductible. However, qualified distributions in retirement, after age 59 and a half and the account has been open for at least 5 years, are completely tax-free. For example, if you contribute $6,500 after-tax dollars to a Roth IRA, and it grows to $100,000 by retirement, that entire $100,000 can be withdrawn tax-free, including all the earnings. This makes Roth IRAs particularly attractive for individuals who expect to be in a higher tax bracket in retirement. Question 18. An investment advisor is discussing different types of orders with a client. A stop order for a security is typically used to A. Ensure a trade is executed at a specific price or better. B. Limit a loss or protect a profit on an existing position. C. Purchase a security only if it rises to a predetermined price. D. Cancel all other open orders on the security. Answer: B. Limit a loss or protect a profit on an existing position. A stop order is a specific type of order used to buy or sell a security once its price reaches a specified stop price, at which point it becomes a market order. For example, an investor holding a stock bought at $50 might place a stop-loss order at $45 to limit potential downside. If the stock falls to $45, the stop order is triggered and becomes a market order to sell, helping to prevent further losses. Conversely, a stop-buy order can be used to protect a short position or establish a long position once a resistance level is broken. Question 19. An investment advisor, IA, firm would need to register with the state administrator in which of the following scenarios? A. The IA has a place of business in the state and advises 5 individual clients who are residents of that state. B. The IA solely advises federal covered investment advisors. C. The IA only provides advice to institutional clients in the state and has no physical office there. D. The IA's only clients are other investment advisors. Answer: A. The IA has a place of business in the state and advises 5 individual clients who are residents of that state. An investment advisor, IA, generally must register with the state administrator if it has a place of business in the state, regardless of the number of clients, or if it has no place of business but advises more than a de minimis number of clients, typically 5, who are residents of that state. The scenario where the IA has a place of business and advises 5 residents clearly triggers state registration. The de minimis rule, under the Uniform Securities Act, allows IAs without a physical office in a state to have up to 5 retail clients there before requiring state registration. Question 20. Which of the following would be an example of an unethical business practice known as selling away? A. An agent executes a trade for a client without discretionary authority. B. An agent sells securities to a client that are not offered through their employing broker-dealer. C. An agent recommends unsuitable investments to a client. D. An agent misrepresents the potential returns of an investment. Answer: B. An agent sells securities to a client that are not offered through their employing broker-dealer. Selling away refers to an agent's unethical and prohibited practice of selling securities to clients that are not offered or approved by their employing broker-dealer. This practice is problematic because these transactions bypass the firm's oversight, internal controls, and supervisory procedures, potentially exposing clients to undisclosed risks and the firm to liability. For example, if an agent sells a private investment opportunity to a client that is entirely separate from their registered firm's offerings, this is selling away. Always remember that all securities transactions must be conducted through an agent's employing firm. Question 21. When conducting a fundamental analysis of a company, an investor would typically focus on A. Historical stock price movements and trading volumes. B. Economic indicators and market sentiment. C. Financial statements, management quality, and industry outlook. D. Chart patterns and technical indicators. Answer: C. Financial statements, management quality, and industry outlook. Fundamental analysis involves evaluating a security's intrinsic value by examining related economic, financial, and other qualitative and quantitative factors. This primarily includes scrutinizing a company's financial statements, like balance sheets, income statements, and cash flow statements, assessing the competence and integrity of its management team, and understanding the broader industry and economic environment. Unlike technical analysis, which focuses on price and volume trends, fundamental analysis aims to understand the underlying business to determine if a security is undervalued or overvalued. Question 22. A client wants to establish a trust to provide for their minor child's education and ensure the assets are managed by a professional while the child is young. Which type of trust would be most suitable for this purpose? A. A revocable living trust. B. An irrevocable trust. C. A testamentary trust. D. A charitable remainder trust. Answer: A. A revocable living trust. A revocable living trust is suitable for managing assets for beneficiaries, such as minor children, during the grantor's lifetime and beyond, allowing the grantor to maintain control and make changes. It allows for professional management of assets, provides for seamless transfer upon death, avoiding probate, and can be modified or even terminated by the grantor during their lifetime. For example, a parent could set up a revocable trust, transfer funds into it for a child's education, and appoint a trustee to manage those funds until the child reaches a certain age, retaining the flexibility to alter the terms if circumstances change. Question 23. An investor is performing a technical analysis of a stock. Which of the following tools would they primarily use? A. Balance sheets and income statements. B. Economic forecasts and interest rate predictions. C. Price and volume charts. D. Company management interviews. Answer: C. Price and volume charts. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity, such as past prices and trading volume. Technical analysts use various charts and indicators to identify patterns and trends in price movements, attempting to forecast future price action. For instance, they might look for head and shoulders patterns, support and resistance levels, or moving averages on a stock's chart to predict its next move, rather than evaluating the company's underlying financial health. Question 24. What is the primary purpose of an investment policy statement, IPS? A. To list all the client's current investment holdings and their values. B. To document the investment advisor's internal trading procedures. C. To establish a clear understanding of the client's investment objectives, risk tolerance, and constraints, and guide future investment decisions. D. To detail the fees and compensation structure for the investment advisor. Answer: C. To establish a clear understanding of the client's investment objectives, risk tolerance, and constraints, and guide future investment decisions. An investment policy statement, IPS, is a crucial document that outlines the investor's objectives, constraints, and preferences, along with the strategies and guidelines for managing their portfolio. It serves as a roadmap for both the client and the investment advisor, ensuring that investment decisions align with the client's specific goals. For example, an IPS would specify the client's desire for long-term growth, their willingness to accept moderate risk, and any liquidity needs or ethical investing preferences. It acts as a foundational agreement, preventing misunderstandings and providing a framework for evaluating portfolio performance. Question 25. Under the Uniform Securities Act, an administrator has the power to A. Prosecute criminal violations of the Act without referring to other authorities. B. Revoke the registration of an investment advisor based solely on an anonymous tip. C. Subpoena witnesses, administer oaths, and take evidence in a state where an investigation is underway. D. Set the minimum net worth requirements for all federal covered investment advisors. Answer: C. Subpoena witnesses, administer oaths, and take evidence in a state where an investigation is underway. State securities administrators have broad powers to enforce the Uniform Securities Act within their jurisdiction, including the authority to conduct investigations. These powers include the ability to subpoena witnesses, compel the production of documents, administer oaths, and take testimony and evidence from individuals involved in a potential violation. For example, if an administrator suspects an advisor is engaging in fraud, they can issue a subpoena for the advisor's trading records and compel testimony under oath. This investigative power is essential for protecting investors and maintaining market integrity.